Video F3, Entry and Exit in the Long Run. This segment is all about the incentives for entry or exit in a particular industry. Long-run equilibrium in such an industry occurs when there's no incentive to get in or out of it. That is, when the expected opportunities in this industry are the same as in all others throughout the economy. When this industry is just as good as any other, no better, no worse, we say that profit is at a normal level. Combining the idea of normal profit and opportunity cost leads to the conclusion that this is an economic profit of zero. But keep in mind that the accounting profit is most certainly positive in this case, showing a normal or typical rate of return. This all occurs because of implicit costs. The entrepreneurs behind this business could put their assets and talent behind something else, and the returns to that something else is, of course, an opportunity cost or an implicit cost of operating this particular business. Let's now look at two opposite cases. First, let's look at a situation when the profit at a particular point in time, or the short run, is greater than the normal level of profit. And we're going to contrast this with the situation where profit at a particular point in time is less than normal. That is, where there are economic losses. Profit greater than normal might occur maybe because market prices increase because demand increases. If you have a region that has more people coming into it, or their income increases, or a good becomes particularly in style, all of these would lead to a short run in which profits were greater than normal in the industry. But the presence of these above normal profits has consequences for the long run. First, starting this off, there's now an incentive to be in this industry and produce this product. So more firms enter the industry. With more firms entering, this has the immediate effect that supply increases. But if supply increases, we know from our supply and demand work that price is going to decline. And finally, if price declines, well, a lower market price is going to mean lower profits. So we're going to have profit returning or falling to the normal level. Let's now move to profit not being above normal, but profit being less than normal because we have economic losses. Maybe this occurred because input prices increased, or because people moved to different types of products, and simply the preference for the product has declined over time. Well, if firms cannot earn economic profits in this industry, some firms are going to choose to leave. So we're going to have firms leaving the industry. And as the number of firms in the industry goes down, we're going to have a decline in economic supply. Fewer businesses, lower supply. Now, falling supply, though, is going to mean that we're going to have rising prices for this product. And the result of rising prices, then, is that profit increases, returning to normal. We can conclude that in the long run, profit provides an incentive for industries to expand or contract. The result of this is that resources are invested in expanding firms where profits are high and prices are reduced over time in these expanding industries. Similarly, resources flow out of industries which are not able to meet the threshold of normal profit levels. The result is that prices increase over time in these industries to restore prices at a level which gives normal profit. Resources are allocated to those places in the economy where profits are not at a normal level, where they're either too high or too low.